If you've ever wanted to invest in bonds but didn't know where to start, you're not alone. Even though bonds are one of the three main asset classes that make up your portfolio alongside stocks and cash, they're still considered relatively complicated by many people. We're here to help clear up any confusion. Here's how bonds work and how to invest in them. We'll be using the term bond and debt security interchangeably in this article, as they're essentially the same thing. Now, let's get into it. What is a bond? You've probably borrowed money in some shape or form, like taking out a mortgage to buy a house, car loan to buy a vehicle, or even student loans to pay for school. And if you're like most people, you've probably had to pay a little extra besides the original amount borrowed. And that extra bit is called interest. Now imagine you're a city official trying to improve your town. You've got a few ideas, like building a new park or refurbishing the local football field. But to do this, you need money, so you decide to issue bonds to borrow money from investors like you. In exchange, you promise to pay back the initial investment plus interest over a specified period of time. That's essentially how bonds work. To better understand this concept, let's look at a real-life example. Imagine you want to buy a $10,000 bond, paying 3% interest over 10 years. This means you would receive 3% of $10,000 per year, or $300 every year for the next 10 years. Once the 10-year period ends, you also get your initial investment of $10,000 back. Now, before we continue, it's important to note that in real life, you won't find bonds with such high interest rates. However, this example helps to explain the core concepts behind bonds. Where can you buy bonds? When you buy a bond, you're essentially lending money to an entity that needs it, like a company, state, municipality, or even the U.S. federal government. It's an alternative way to save money that comes with less risk than other investments, like stocks. Now, if you want to buy bonds from the U.S. government directly, you can check out the Treasury Direct website. Here you'll find bonds backed by the full faith and credit of the U.S. government. They come in various lengths, from a few months to 30 years. On the other hand, bonds from corporations and municipalities can't be bought directly. Instead, you must go through a broker, which is why it's important to choose one that has a wide selection of bonds and low fees. How to make money with bonds? There are basically three ways to make money with bonds. 1. Holding a bond until its maturity date and collecting interest payments. Most bonds pay interest semi-annually, meaning you'll get a payment twice a year. 2. Buying zero-coupon bonds and holding them until the maturity date. This type of bond is sold at a discount to its face value. Take a look at this example. Let's say you buy a zero-coupon bond with a face value of $10,000 for $8,000. After 5 years, when the bond matures, you'll receive $10,000 in cash. 3. Selling bonds for more than you initially paid. Since bond prices fluctuate just like stock prices, you can profit by buying low and selling high. Let's say you buy $10,000 worth of bonds at face value. It sounds simple enough, right? Well, there are some things to consider. Before you invest in bonds, let's discuss some factors that affect bond prices. Bond prices and interest rates. You might be wondering how interest rates affect bond prices. The answer is, they have an inverse relationship. When interest rates rise, bond prices tend to fall. And when interest rates drop, bond prices tend to rise. To see how this works, let's break down this concept using two separate examples. Example No. 1. New bonds being issued. Imagine there's a new bond offering by a major corporation that pays 5% interest. This means that if you want to buy this bond, you'd have to settle for the 5% interest rate. On the other hand, if interest rates happen to drop to 4%, the corporation is still offering a 5% interest rate, making it more attractive for investors. This increase in demand pushes up the price of the bond above its face value. Example number 2. Existing bonds being held. Let's say you already hold a bond with a 5% interest rate. If interest rates happen to rise to 6%, it means that newly issued bonds offer a more enticing 6% interest rate. As a result, your 5% bond becomes less desirable, leading to a decrease in demand and a drop in price below face value. This might sound confusing, but it's really just supply and demand in action. How are bonds different from stocks? Bonds are very different from stocks in many ways. First, when you buy a stock, you're buying a small piece of ownership in a company. With a bond, you're simply lending money to a company or government entity. Second, stocks typically have much higher price fluctuations compared to bonds. Lastly, stocks typically have a longer history of providing higher returns than bonds. However, this doesn't necessarily mean stocks are better than bonds. Remember that stocks also come with a greater risk of loss. Let's talk about bond ratings. In the world of finance, bond ratings play a crucial role in determining their safety and potential returns. But wait, don't freak out yet. They're not that complicated. Essentially, a bond rating is like a report card that tells you how risky the bond is. The higher the rating, the safer the bond is, and vice versa. The main companies responsible for assigning these ratings are Moody's, Standard & Poor's, and Fitch. But here's the inside scoop. Ratings go from the highest investment grade, which is AAA, all the way down to the lowest speculative or junk level, known as DDD. Now keep in mind that just because a bond has a lower rating doesn't automatically mean it's a bad investment. It just means it has a higher chance of defaulting. In fact, some investors actually target lower-rated bonds because they offer potentially higher returns to compensate for the increased risk. What are bond funds? If you don't have a lot of money to invest and can't afford to buy individual bonds, bond funds may be a great option for you. A bond fund is like a basket that holds many different types of bonds. It allows smaller investors to diversify their portfolios without having to buy individual bonds, which often have minimum investment requirements. Additionally, a bond fund is managed by a professional fund manager who makes investment decisions on behalf of the fund's investors. This can be beneficial for investors who don't have the time or expertise to manage their own bond portfolio. What are the different types of bonds? There are various types of bonds, each with its own unique features and benefits. Here are some of the most common ones. 1. Corporate bonds. These bonds are issued by private companies to raise capital for various business purposes. Typically, corporate bonds offer higher interest rates compared to government bonds, but they also carry a higher risk of default. 2. Government bonds. These bonds are issued by national governments to finance their spending. Examples include Treasury bonds in the United States, UK government bonds in the UK, and German government bonds in Germany. Government bonds are generally considered to be less risky than corporate bonds, but they usually offer lower interest rates as well. 3. Municipal bonds. These bonds are issued by local governments or municipalities to finance public projects such as schools, hospitals, and roads. Municipal bonds are often exempt from taxes, making them an attractive option for investors who want to reduce their tax burden. So there you have it, a breakdown of bonds and how they work. Hopefully this video helped clear up any confusion you might have had about this complex topic. And if you found this information useful, please consider subscribing and leaving a like. We appreciate your support. Until next time, happy investing.